Sounds good. Hey, folks, how you doing? Bill and Brian with Energy Rogue here coming to you for a weekly update. And this is going to be the week of June 20. I never can keep up.
No, it's going to be July.
29th of the month?
July
No, it
2nd.
starts in June. Well, that's when we're going to print it out, July 2nd. But it's
Yep.
the week of
Yep.
June 22nd. So anyway,
Yep.
folks, we're talking about the rest of the balance of 2025. I know it has been crazy this month. June has been a crazy month. It's not probably going to get any more crazy, but I say that with a little hesitation in my voice, you noticed.
Gosh, it disturbs me to see you, Gaston, looking so down in the dumps.
Yeah, exactly. Apparently, you didn't take it.
We got to try and keep a little bit of levity and humor because there is a lot of serious discussions, and we are going to talk about these in there. But
Right.
you were just saying that we've already seen probably 3 years worth of volatility in action in the first half of 2025. Don't you think?
That's right. That's
We've
right. We
had
started out at
wars,
$4.
wars,
Remember?
attacks. We've had wars, attacks, and tariffs, trade wars, economic wars, concerns around demand, concerns around supply. Which way is up?
Concerns about economies of multiple countries.
I mean,
and yeah.
No matter how many times you save the world, it always manages to get back in jeopardy again. I
mean, no.
For anybody that hadn't seen it, yeah, for anybody that hadn't seen it, that's The Incredibles. It is a phenomenal Pixar movie, and we're making light of some serious issues. So bear in mind, it's to keep levity. It's not to diminish any of the impact because these activities, these things impact people's lives. Energy impacts people's lives, whether it be oil, natural gas liquids, refined products, or electricity. So what we're going to talk about is all the factors that are coming together in the first half of 2025 and leaving us with question marks. What happens for the rest of 2025? We've already seen war, we've seen weather, and we're going to see weather again this summer. And then add in Washington. This is driving energy market chaos. I feel chaotic. Do you feel chaotic, Bill?
I listen, energy's always been chaotic, and I do feel chaotic, but we don't have to go out there and like bring it on. I mean, so the, the I get the feeling sometimes that every time we go here, okay, we got energy figured out, it's going to do this. I hear energy says, "Here, hold my beer."
It's always careful. So anyway, we're going to dive into it. We're going to try and keep this condensed. However, this is a longer session just because of the topic matter. Really, what we were trying to take a look at is crude oil has been incredibly volatile. We started the year at WTI up around 80, and then now we're down at 65. And in between, we've gone everywhere from 55 to 70 to 60 to all over the place. And then natural gas, meanwhile, has transitioned from 2024. Are we ever going to get really above $2 to what did you say that range was? Like $4 to 275?
Yeah, we started at $4 and then we went down to 275. Then we're back up at 415. Then we're back down. You know, the what's interesting is what that tells you is that our supply demand is so in balance, any impact causes volatility.
Right.
And that's why it's important. Brian and I talk about this all the time, is that 1%, whether it's natural gas or crude oil, 1% change in the supply drives a significant amount of volatility in both those
or the
commodities.
demand. Either way, 1% either way. And when you have 1% growth on supply, but 1% growth on demand, you're technically flat, right? So
supposedly, yeah. So it depends what time
supposedly.
of year it happens.
Definitely true. Well, let's go ahead and dive in. So, crude oil or natural gas, which one is going to be more volatile in the second half of 2025? Um, any bets on that, Bill?
You know, I really think that because of the weather thing that we got coming up, I think natural gas is going to end up being more volatile. Though crude oil can surprise you every time. Every time I think it's, it's sort of got to figure it out because believe it or not, demand for crude oil is going up
Right.
and it's going up more globally. So there's going to be something happen that we're not in touch with right here in the U.S. that could cause that crude oil to get. And so it's going to be interesting to me to watch one the relationship between NYMEX crude oil in the field in refinery postings
Right.
and the relationship between WTI and Brent. I think those are the two things that I'm looking at in crude oil to understand its volatility.
Yep. Yep. And I think that that
Natural
is a. Oh, go ahead.
and natural gas to me, LNG demand and power demand. And we've got something coming up that's really interesting. We're not going to get too depth in this, and we'll talk about more about that, or give us reach out to us. But we've got a off grid thing happening with AI to where they're going to be getting natural gas demand to create electricity that we won't see on the grid. It'll be a microgrid type of thing. But we have a way of tracking that, and we're gonna be talking about that more, just not in
Yeah.
this particular presentation.
Well, and we'll describe our product a little bit later, but when we look at the international prices, this Brent WTI spread, we keep track of this every single day. And then, as Bill was talking about on the LNG side, I want to point out something. We're recording this in the week of June 25th. And when we look at TTF and JKM, you can see a spread, $1.72. 2 weeks ago, they were trading within 20 cents. So JKM, which is Japan, Korea, and TTF has spread out. And conversely, on the Brent to WTI spread, this one, when prices were higher, Brent and WTI were closer together. So it's important to keep track of that. And these spreads and volatility, when we're looking at the volatility, it also depends on if you're looking at one priced commodity, meaning WTI or Brent, or both of them together, because you come up with different answers. So it's important to define that a little bit.
And they're not by themselves. They're related.
Right.
So, and that's what we bring out is the correlations between all those.
Yep.
So Brian and I are, I guess that makes us like relationship people.
Well, clearly the guy in glasses doesn't like the other guy. That's one of our YouTube trolls that told us that we didn't like each other. Bill and I have been friends since 1995, and it's part of the reason that we have created a movement for this type of energy analysis, which combines fundamentals, technicals, sentiment all in one, so that you don't have to spend 30 hours a week digesting it. But we'll talk more about us later. So what we're going to talk about today, we're going to talk about where we've been since January to June 2025, current market overview, and we're going to look at the fundamental drivers of the volatility, crude oil versus natural gas head to head on all these different factors. What are the key risks and the watch points, and what the final verdict is, and what to watch. So it is debatable, but it is interesting. Where we've been in crude oil, January to June 2025, price range has been 53.87 to 77.50. That's not accounting for the day in January that we did get over 80, so that's actually a misprint. But what are the key events? I mean, obviously, we're talking about a significant volatility here from 53 almost $30, almost $30, $25, or based upon 53, a 40% volatility factor. What are the key events? There's been ceasefires, missile strikes, Israel, Iran conflict. Now U.S. is involved. OPEC plus production guidance. Are they going to bring it back on? How quick? What is happening there? And there is still about 1.5 million barrels a day offline. Now you get into trade wars. Washington. What is happening there with tariffs, with trade wars between U.S. and China? And then a weak demand outlook from China. And Brian, if you are listening, Brian, my friend in New York, if you're listening, we were talking about tariffs the other day, and you made one of the most articulate thought patterns as far as what the tariffs might have been is firming up supply chains for what is coming. And what has been coming is an escalation in Iran. And so this might have been part of an orchestrated plan. And that is a new perspective. And that's what Bill and I are here for. Bill and I often disagree. As a matter of fact, we were just talking about how we disagreed before this, but we're not going to air that out. Otherwise, we'll be here all day because I say the sky is blue. He says it's purple, and clearly he is wrong. So that's this. This is when you come back. This is when you say you're crazy, Brian.
I don't think you're crazy, Brian. Everybody else does, but I don't think so. I don't care what everybody else says. I don't think you're crazy.
Touche, touche. So there is a continued weak demand outlook from China. And if we just take the last few weeks as an example, with escalation from Israel, Iran, and then the U.S. getting involved, we went from, somewhere in the high 50s all the way up to 78, and then back down to 65. We came back risk off because a lot of people are looking at the demand signals on crude oil and thinking we really have enough supply, and they're taking the under on any volatility for the Straits of Hormuz. So,
Well, now the other thing is, I did notice that Iran had approved the closing of the Straits of Hormuz. I also noticed that they don't own all of it,
right,
so it's
right.
one of those things that work. The other thing that I noticed that we haven't really talked about in a while, and we can do that later, is that we've just completely taken the Ukraine Russia war off the table.
Hmm.
And yet every
Well, it's
day
still
Russia
there,
is burning more and more fuel.
right?
Yeah, I know, but it has an impact because every day Russia is burning more and more fuel, and they have to get it from somewhere.
That's true. That's true. Which means less
And
in
it's
the
not easy
export
on their
markets,
economy.
right?
Right, exactly.
So where we've been on natural gas, January through June. Early bearish fundamentals, the price range has been 275 to 415. There's been soft LNG exports, weak power demand, and that's more talking about in May and June. But later, what's to come is a bullish turn. And that is going to come in heat dome, which if you listen to our live cast last week with Brendan, we talked about that heat dome and we talked about it at length. LNG exports, are they going to return to 16 plus BCF a day? A fear premium is there because of the potential of a disruption. Because one thing to bear in mind is when we're talking about the Strait of Hormuz is, I want to point this out, when you look at the global LNG, you have three areas that are the big drivers: the United States, Australia, and Qatar, which is right there. So the Strait of Hormuz is
Also in the
right.
United States, it's really the Gulf Coast.
Yeah, that's true. That is true. So, but roughly one third of the LNG in the world comes from Qatar, which is impacted by the Strait of Hormuz. So there is a fear premium there. And that means natural gas has formally transitioned to a global commodity. That's
Yes.
it's made the leap over the last couple of years. Now the current market snapshot: crude oil 65, 68, natural gas 385. Actually today it's trading a little bit off that. Israel, Iran, and obviously by the time you see this is being pre-recorded, so just bear that in mind. On crude oil, Israel, Iran ceasefire, and again, we're recording this on June 25th, lowers the risk premium. So if something happened in between, this live stream is not capturing that. U.S. policy shift allows China to buy Iranian oil, and the market
Which I
is
think, it was an interesting statement, by the way.
well.
How are we? I mean, how are we allowing, quote unquote, China to buy?
It's
I always
happening
love it.
already. Like
Yeah, it has been for over a year. So
that's like I'm going to allow the sky to be blue. So
that's right.
it's just because you say it, I'm going to allow H2O to have two hydrogen molecules and one oxygen. I'm going to allow that, Bill. So,
Well, there you go. So since I'm going to adopt a law that will allow things to fall to earth when you let go of them. I think I'll call it the law of gravity. Now it's legal.
so anyway, okay. So crude oil, those are some of the big items. Natural gas elevated on heat wave forecast. Little and concern around the Strait of Hormuz. Storage injections are continuing to add to the 5-year average balance, and the output is still near highs at 105.3 BCF a day. Note, if you go to different sources, you get a different number. So there are probably 4 different forecasts. Some say that 105.3 is 103.7. Some say it's 107.8. So bear in mind, this is the source that we've determined is equalized into a condensed fashion and most representative of where supply is right now.
And the reason
So,
that's important because of what we said at first is that 1% makes a big difference in the price.
mhm,
And so 1% of that supply can make a big difference in the price.
absolutely. Um, Volatility drivers for crude oil, geopolitics, obviously that's a big driver. Policy
Right.
shifts, sanctions. I'd argue sanctions don't really do anything on Russia and Iran, but that's just me. Um, OPEC actions, a return of 2.2 million barrels a day, that has already started to come on. I would say probably 1.5 to 1.7 is left. Demand
The real
uncertainty.
the real the real question on OPEC and their actions is we've seen that they have the capability to do this, but we don't know if they actually have the will or capability right now to ramp it up, how fast they can ramp it up.
Well, it's like what you always say, Bill. It's the ability and the will to make it
Right. The
happen.
willingness. Right. Hmm.
So I believe there's 1.5 to 1.7 of ability, and what is subjective right now is do they have the will or desire or want to bring that online, right?
And just to realize the last half a million barrels are harder to get because you're pushing all your equipment to their max.
Right. Yep.
And so, so at that point, you actually increase the ability or increase the probability of having mechanical breakdowns.
Right. Right. There's still demand uncertainty, slow Chinese growth. It's part of the reason that after the ceasefire, that the de-escalation took $10 off the price.
Right.
There is some strong output limits that limit upside on U.S. supply. I don't see U.S. supply adding in 2025. I see it declining. Um,
Well,
so
decline is
I
catching
think
up with supply without more rigs being active.
for the last, well, we can actually look at it real quick with this handy dandy tool, which we'll talk about later. But let's go ahead and take a quick look, and this will show how much we've actually flatlined on crude oil production. So this is our crude oil production from a year. And as you can see, we have oscillated between this 13.2 and 13.6, with most of it sitting right here. So about 13.5. That's roughly where we've been for the last 8 months. And we've been dropping rigs for the first 6 months of 2025. So I think that is going to mean production in the US is going to go down. What are the volatility drivers for natural gas? What do you see here?
So weather is probably one of the biggest, I think, variables as far as putting spikes in it.
Mm-hmm.
So when you talk about weather, in the winter it's heat, in the summer it's power. So that's what you're going to be looking at.
Right.
LNG is pretty steady. I mean, we're seeing right now there's about 16 BCF a day going out. We probably have a capability of just right at 18 BCF a day. So there's still some room to move more LNG if we needed to. And so that in itself, that little 2 BCF could change the price of natural gas pretty quickly if there
Yep.
was a demand either in Asia or Europe.
Mm-hmm.
Storage trajectory, we're a little high for right now, but I think that's going to flatten out over the next 60 days to where we'll be back into the normal range easily by the end of August. And
Yep.
so, and then production probably is the biggest concern. Until gas gets to about above $5, we won't see the big deep gas come on because that's where it needs to be able to
drill
actually
to drill up
be
there.
profitable.
Yep. And
Yeah.
it again, we'll talk more about this later, but this is part of the reason that we take a look at all of these different factors on the fundamental side for natural gas, where we look at supply side, dry production, LNG imports, Canadian imports, because that's a different story. We'll save that for a different day on Canadian imports. And then we take a look at the supply demand balance, and then we compare it versus last week, last year, and a 3-year average. And what you can see is we are significantly above the 3-year average on 14.5 versus 12.3, so about 2 BCF. That makes a big difference. And this is part of the reason all of these factors are important to track and monitor and keep track of. And if you're not, natural gas price swings are going to catch you by surprise. And that's
Right.
totally fine. But this is the tools, these are the things that you should be watching, because one of the key factors that we take a look at is LNG output. And when we look at the LNG output, the reason it's so important is because when we're looking at, where is it? The LNG price analysis. When we look at this right here, that means that LNG is likely to go up as long as we can deliver to JKM, which is limited by the Panama Canal. So again, natural gas is no longer a US only price, it is international.
Right.
So let's look at
And
the
majority of that
head-to-head on.
price is shipping.
Yeah. Let's look at the head-to-head crude versus natural gas volatility. Geopolitical risk, crude oil, high. Natural gas is moderate. Years ago, natural gas would have been no impact on geopolitical.
Right.
Now it is a geopolitical moderate risk. So especially with Qatar. Now, weather sensitivity, crude oil, I would say for this time of year, it's low. In the winter,
Right.
there are some more impacts.
But that's
But
even that's nuanced. So
mhm. Weather sensitivity on natural gas is very, very high.
right.
Supply discipline on crude oil is going to be OPEC plus dependent. I would say plus some non-OPEC in the Americas, but the Americas is not really in a position to add to that growth right now.
Well,
And then
I think the catch there will be for a small piece of it. I say small, maybe 300,000 barrels or plus would be Nigeria. I think that's a place
yeah,
to watch.
yeah. And then of course, when you're talking about Nigerian crude, Middle East crude, and U.S. crude, you're talking about different qualities, and often what these different qualities do is they result in different downstream products on the other side of the refinery, and this is where the industry spends a lot of time.
Yeah, you blend.
So that's sorry, couldn't help it. Okay, and natural gas on the supply discipline is going to be producer led, and this gets back to what Bill was talking about with the deep gas, meaning Haynesville, Utica. The economics don't start making sense until you get into 4 or potentially 5 to where they can underpin, because these are deep wells, but these come on at very, very high rates. So there's probably a cap on
Very
how
high rates.
far up we can go and how quick we can go. And that's what I'd be looking at. Demand certainty. On crude oil, it's a pretty weak certainty on the demand side. The signals that we've gotten so far is demand is off on the crude oil side. Natural gas is going to be very, very weather dependent as well as AI dependent, because we've been tracking this one right here, because this is actually going to tell us what the future is going to hold when we look at electricity, because this is going to help determine what our storage position is for the winter. When we look at power over the last several years, one thing you can see is that we've increased during the winter period. We dropped here. That is a little bit concerning on the demand profile, but otherwise we've been stair stepping up. So we still have this week to come, but we are expecting the growth this year on the power side, but it's a to be determined on whether or not that's going to happen. So I would say the seasonal demand is going to be very weather dependent. That's why we have some weather charts, and that's part of the reason that we had Brendan on last week. And Brendan, if you're
And if
watching,
you look at,
thanks again.
yeah, go ahead. And if you look at our natural gas future monthly chart, you will see the usual curve for natural gas. It has a pretty much usual curve when you see that, and it's pretty much the same curve every year. As you
Right
can see
here,
that, you see how now
it dips
the
down and
depth
then
of that,
bottoms out and then recovers.
right? It does this every year. It's been doing this ever since we've done it. The
Right.
difference is that we see some extremes in the prices based on the availability and the changes in the weather, but the curve will pretty much stay the same way almost every year, with a few
Right.
changes. But you can see 26 and 27 are variable. But the problem with 27 is that you get out there. This is the problem with future curves. There's no reliable, um, not volatility, but fungibility out there for those further out contracts.
Yep. And this
There's
distance is telling you,
liquidity therefore.
right. And this distance is telling you that there's a
Right.
lot of concern for supply tightness into 2026. At least that's what the market signals. Now the market sentiment on crude oil is currently bearish. That would change with any Strait of Hormuz, any escalation
Right.
of conflicts or wars. But the crude
So,
oil
and
market,
really, I think all that bearishness is all off China.
yes,
I think
yes,
that's the one place that's where all that bearish sentiment is coming from, is from China, and probably rightfully so. But there there's a lot of things
I was
about China
just
that you probably need to look at.
I was just on a podcast at a Gulf Intelligence, and if you're listening to Gulf Intelligence, that is one of the best sources for daily energy podcast that is focused around crude oil. And I was just on a podcast with a analyst out of Singapore, and she's with Vanda Insights, and she actually founded the company. She was saying that she expects China to get into a 1 to 2% growth, which looks a lot like the US, a lot like Europe. That is one of the most outlying factors that I have heard from an analyst as far as growth factors for China. And a 1 to 2% growth means we're not going to see much crude oil growth on the demand side.
Right.
So,
So 1 to 2% growth. We need to explain this, Brian. China has always grown somewhere between 4 to 6%.
mhm.
But as economies
I
get
would say
mature
6 to
and
8 until the last couple of years, right?
well, that's true. Yeah. Well, based on what we know, the data that comes out of China sometimes gets to be a little bit fuzzy.
Right.
But so 1 to 2% countries would be great for China. That is that's a significant downturn, and part of it is there's been some real issues about the population of China, the demography. So that's something to looking at as well, the demographics of these countries.
hmm Yeah. Yeah. Natural gas is cautiously bullish, and it's cautiously bullish because it does depend on a lot of weather. Three scenarios for the second half. Scenario one, renewed Middle East conflict. Crude oil spikes, goes to around 80 or even greater. And natural gas follows mildly based on LNG fears because there's only so much that the US can add to the export mix to gap for Qatar. And it's part of the reason that we have seen the increase in the spread between TTF and JKM. It's because there's only so much that can really be filled by the US. So that's why we would see scenario two, normal weather and a recession, crude drops to 50. Natural gas flattens or drops below 3. Scenario 3 is a hot summer with a hurricane season. Natural gas spikes up to 450 plus, and crude is stable in the mid 60s. I actually, out of these three scenarios, which one would you align with here, Bill?
Well, Brian, I'd like to take door number 3.
You stole it. That was going to be my door. I do see a hot summer. I may not be
I'll
as
take door number 3 for 415 and 68.
interesting. Okay, I was going to say I don't see quite that spike unless this heat dome in January or July really takes off. But crude stable in the mid 60s, I see that as highly likely. But natural gas is probably going to correlate and probably hang out a little below that mark, but I think that's the one that is closest to the pin. So the final verdict: natural gas is more likely to be volatile in the second half, while crude oil remains sensitive to geopolitics, but fundamentals cap the upside. So, what to watch for? What what are the key factors here? Hurricane threats in August and September. That is a demand destructor. That means price goes
Right.
down.
Exactly.
So that's important to understand. Historically, that meant price goes up on natural gas. LNG export volumes versus global tension, both of those are important. OPEC plus compliance versus US inventory data on the crude side, summer power burn and AC demand for nat gas, and Chinese economic indicators, which are indicators for both. And it's part of the reason that we actually created Energy Rogue, and we have Rogue Radar with weekly snapshots as well as a daily summary that captures everything that you want to know for crude oil. You get a market summary, technical analysis that runs every single day, fundamental analysis, international price analysis, Brent and WTI, OPEC analysis. So it takes a look at the OPEC report, gets sentiment from the OPEC report. So if you have time to read 110 pages, go read the OPEC report. They publish it. It is great. Or you can come here and get, well, what have they changed? What have they revised up or revised down? They've revised non-OPEC supply growth down by 100,000 barrels a day. So every single month they put out a new report. And that's why keeping track of this economic analysis, taking a look at the dollar index, the 10-year bond, S&P, the VIX, gold, it's all interrelated. So you have this alongside natural gas radar, which does the same thing every single day. CFTC, commitment of traders, LNG, news and sentiment, plus our bread and butter. We provide a extensive video that goes in depth on Monday, in depth later in the week after the news releases have all been out. Plus, you get 2 PDF reports, one on Monday, one later in the week when all the storage numbers and production numbers and demand numbers are out there. And how much is that, Bill? How much is Rogue Radar?
Well, funny you should mention that right there. It is cheaper than buying a cup of Starbucks coffee every day. Of course,
Or
my first
actually,
car was cheaper than buying a Starbucks coffee every day. But
if you click the link below, you'll come to this link. If you scroll all the way down, you'll see it is actually less than a toaster. Now, that's a fancy toaster. That is there are cheap toasters out there, but for a fancy toaster, Rogue Radar is cheaper than that. Plus, right
well,
now, you can sign up for a 14-day free trial. All you have to do is go to the link below. It's 14 days for free, and you get to experience the videos, the PDF reports, plus all of now these charts are for our Rogue Edge members. Plus, you get all of the daily radar that actually goes even deeper and gets into Fibonacci, machine learning, AI analysis that gives you kind of an insight on where things are going. So listen, would love to see you. We're here to help you. Part of the reason we spent close to 40 minutes today talking about what's ahead, so you know where to look. And if you can't
Ryan,
sign up for
I
something or
cannot believe
something
it.
like that, what's that?
I cannot believe you used that 4-letter word.
Oh, what four-letter word?
Free. I can't believe you used the word free. It's actually free for 14 days.
If you put your effort and
I thought we were
concentration into
selling
playing
stuff.
to your potential, to be the best that you can be, I don't care what the scoreboard says at the end of the game, in my book, we're going to be winners.
There it is. In my
There it
book, we're
is.
going to
There
be
you
winners.
go.
And somehow Bill's video went to a gear
Went
icon.
nuts. Yeah, I was going to
I'm
say.
not
What happened
sure.
to that?
Now he's just a voice in my head. He's living rent free in my head. So
There you go.
what's what's going on with that? So listen,
I have no idea.
listen, folks, thanks for spending time. If you've made it this far, energy, oil analysis, natural gas analysis. We also cover natural gas liquids, refined products, and electricity. If those markets matter to you, stay educated. And we just gave you the hit list of what to watch for in the second half of 2025. Plus, we gave you our insight, which bear in mind, if you ask us tomorrow, it might be different because there are new factors. And that's part of the reason staying on top of this every single day is what we do all the time. So listen, thanks so much. That's all I
Every day
got.
it's new and improved.
It's new and improved. So
Every
that's
day.
all I got. Do you have any final words of wisdom for the good people out there?
Well, maybe.
Oh, and remember, next Friday is Hawaiian Shirt Day.
All right, that means for our next one we gotta wear our Hawaiian shirts.
And we have them.
Yeah, and we do have them. So listen, folks, thanks so much. We will see you next week. Drop us a comment if you have any questions, and there is a link down below. And if you want to join Rogue Nation, we are growing, and we'd love to have you inside. So that's all we got. Thanks so much. Have a great, great Wednesday.